Good morning, friends. Happy to see all of you for today morning for this session. Today we are taking up bond portfolio management strategies. We have seen the previous sessions, duration, computation of duration, and properties of duration, and how to compute the duration for zero coupon bonds, how to compute the duration for fixed income bonds, how to compute the duration for perpetuity, all that we have seen. And then we have seen how the duration is changing in relation to yield, maturity, and coupon rate. All that we have seen, how the maturity and the duration are directly related. Higher the maturity period, higher the duration, and coupon rate, yield are inversely related. Uh, all that concepts we have seen, and we've looked at the case study. And we are in the last part of this bond portfolio management. What are the strategies an investor can have to keep all the bonds in his portfolio? There are two types of strategies that we have. One is passive and active. Passive strategies and active strategies. Passive strategies doesn't mean that investor does nothing. Even he is not directly involved in buying these bonds. He has to determine whether these bonds are suitable to his investment avenue, to assess the risk. And he has to assess the risk periodically, assess the risk such as default risk and call risk. He has to assess the risk periodically and reasonably diversify his investment. And he should periodically monitor his bond portfolio to ensure that his holdings or his investment to match his risk preferences and objectives. So these are all the strategies for passive strategies. So he has got two types of strategies he can keep. One is the buy and hold. Another one is indexing. Buy and hold, an investor who wants to buy this particular bond, buy that bond and hold that strategy, hold that particular bond to match his return. Such an investor chooses a bond portfolio that promises to meet his investment objective and hence spends time and effort to his initial selection. So he has to buy the bond and hold the bond to match his return and to assess by assessing his risk. Another strategy that he can follow is indexing strategy. That is based on market movement, based on market index movement, he can buy and hold strategies. Bond index is not that much common in India. Bond indices are uncommon as we have a stock index, Sensex and Nifty. So based on market movement, you can buy the bonds and hold the bonds. So this strategy is based on buying bonds based on market price. We always assume that capital market is highly efficient. Efforts to find underpriced securities to time the market. So this particular indexing strategy calls for building a portfolio that shows a well-known bond index. So IBEX is a popular bond index, as we have Sensex and Nifty, which are very common index for stock indices. But IBEX, it's one of the indices in India. And we have US bond indices, Lehman Index and Solomon Brothers Index. These are all the indices of US bond index. So based on market index, you can buy the bonds. So those are all two different types of passive strategies. Then active strategies, meaning to say a bond holder, a bond investor is having the bond and how he can enhance his return by minimizing his risk. That's what we say active strategies. Active strategy here, what we mean is a bond holder is holding the bond and how he can enhance his bond return. So one, he can forecast his interest rate. By forecasting interest rate, he can predict his bond return. As all of us knew, bond price and interest rate are inversely related. Higher the yield, lower the price. Lower the yield, higher the price. Both are inverse related that we have seen earlier. So hence, if an investor expects interest rates to fall, and he should buy the bonds because the bonds will increase, preferably bonds with longer maturity or with a longer duration, so that he will get a price appreciation. On the other hand, the investor expect the interest rates to increase. He should avoid the bonds, particularly bonds with the longer maturity. Such bonds price will decline later, so he will face capital depreciation. So it must be borne in mind that the interest rate forecasting is a very, very difficult task, and it's highly uncertain task, because forecasting those interest rates is highly difficult one. A wide range of models are used for interest rate forecasting. Some models are based on forecasting the expected inflation rate, uh, which is not also easy to predict the expected inflation. So by forecasting the inflation rate, you can forecast the interest rate, but which are all highly uncertain model. The second one is the horizon analysis. Second active strategy is called the horizon analysis. It's a method of forecasting the total return on a bond over a period of time. So we forecast those return. By having that bond, we can forecast that particular bond return. So here, a few steps are given. So when we read the steps, we may not understand. So we look at the case study, and then we will come back for the steps. So we'll take a bond portfolio management strategies case study that we have seen earlier. Yeah, yes, correct. So look at that, the case study. It is given in your LMS. An insurance company has an obligation to pay 6,52,780 after 13 years. The market interest rate is 8%. That is, the yield is 8%. The present value of the obligation is 2,40,000. The present value is 2,40,000. The insurance company, it is not the case. You can please come down. You can please come down. Yeah, yes, this one. Yes, this is a horizon analysis. Yes. A 10 lakhs par 6-year maturity bond, 8% coupon rate paid annually, currently sells at yield to maturity 7%. So 8% is the coupon rate. 6-year maturity bond, and yield is 7%. By looking at this, what we can understand is yield is less than the coupon rate. The price will be higher than par value, because price and yield are inversely related. The coupon rate is higher than the yield, so the price will be higher than the maturity value, that is 10 lakhs. So a portfolio manager wants to forecast the total return on the bond over the period of 4 years. as his horizon is 4 years. So he wants to keep these bonds for 4 years. Then afterwards, he wants to invest in some other bonds. So his horizon period is 4 years. So he believes that 4 years from now, 2-year maturity bonds will sell at a yield of 5%, and the coupon income can be reinvested in short-term securities over the next period of, or next 3 years at the rate of 3%. Not 3 years, sorry, it is 2 years. Next 2 years, you can correct it there. 2 years at a rate of 5%. So what is the expected annualized rate of return over the 4-year period? Now, first we need to calculate, the first step, we need to calculate the current price of the bond. By looking at the first sentence. By looking at the first sentence of the case, 10 lakhs 6-year maturity bond, 8% coupon rate. So 8% coupon rate means we will get 80,000. 80,000. 8%, 10 lakhs, 80,000. 6 years. So 80,000 divided by 1.07 power 1 plus 80,000 divided by 1.07 power 2 plus 80,000 1.07 power 3 and so on till 6 years. And then 6th year you will get to 10 lakhs. So 10 lakhs divided by 1.07 power 6. Okay. So the present value index factor annuity is 4.776. That is for interest period, and present value index factor is 0.666. So you multiply, you will get 10 lakhs 47,280. So instead of dividing it, here you are multiplying when this present value factor is given. Either you can, usually what we do is we'll divide it and then we'll get the answer. If the index factor is not given, the present value factor is not given the case, you can divide it and you can calculate, as we do usually in every case study to compute the price. So here the interest present value factor is given, you just multiply and get the value. So the current market price is 10 lakh 47,280 because the yield is less than the coupon. Now we need to, after 4 years, his horizon is 4 years. So after 4 years, he wants to come out and he wants to invest in another bond, which yield the 5%. Because when you take the other bond, which is having lower yield, that the price will increase. The lower the yield, the higher the price. So he wants to do it. He wants to invest in the bonds which is yielding 5%, so that the price will increase after 2 years. Sorry, after 4 years. So 2-year period, what is his value? What is his forecast price? That is the second step. We need to forecast the another bond where he wants to invest. There is 80,000 for 2 years. The yield is 5%. And then after 2 years, you will get back the 10 lakhs. So 5%, 2 years, present value index factor annuity is 1.859. And the present value index factor is 0.907. The answer is 10,55,720, which is higher than the maturity value. The price is higher because the yield is low. Yield is only 5%. Okay. Now, third step, we need to calculate what is his total return by having this particular horizon period, horizon strategy. So he's keeping this bond for 4 years. So after 4 years, he's reinvesting. So 80,000, and he's reinvesting at 5%. So 80,000, 1.05 power 3.